We have Greece's debt situation certainly making many sit up and take note, but as forecast for debt to GDP ratios increase significantly among some of the big players in the global economy like Greece, the US, India and Brazil, Sub-Saharan Africa seems to be lowly leveraged, with sovereign debt metrics looking overall more favorable. To what extent is this reflective of the reality on the ground?
Thanks. Well, I think that's actually the reality. Africa is low leveraged, and the continent went through a cycle of debt forgiveness in the 2000s. I mean, let's just take the case of Nigeria. Before 2005, external debt was $35 billion. After the debt deals of the Paris Club in 2005 and London Club in 2006, the country became virtually debt-free. So external debt is currently about 4 billion. Domestic debt is 20 billion, so that's about 11–12% of GDP. And you have the same picture across the board. I mean, let's say a country like Zambia has a debt to GDP ratio of 26%. In Kenya, it's a bit higher, maybe 40–42%. I think Ghana, to some extent, is an outlier. We're talking about 60%, but even that is likely to improve over time as the country starts producing oil.
If we look at then what's cushioned us, is it the fact that we have gone through, in most countries, the cycle of debt forgiveness in the 2000s?
Yes, absolutely. I think that was the main driver. Most countries went through the so-called EPIC process. EPIC stands for highly indebted poor countries. And so their external debt was basically written off. In some other cases, you had specific deals for the Paris Club and the London Club. But I think overall, yes, there was that cycle of debt easing.
So putting us in a position now where we've got Sub-Saharan Africa economies and governments having simultaneously implemented these counter-fiscal policies to boost growth. Broadly speaking, one would have to assume then, given what you've said and the fact that they're on these massive growth drives, that our fiscal deficits in 2010 are still very manageable within a global context. Is that reflective of what's happening?
Yeah, absolutely. Well, to put things in context, deficits will rise, but let's say at 6% or 5% of GDP in Nigeria and probably 6% of GDP in Kenya, it's still manageable. Even in countries where the deficits were high, like in Ghana, minus 15% of GDP in 2008, there are signs of fiscal consolidation. So I think really the situation is not as bad as sometimes highlighted in the international press. As long as those countries can finance the deficit domestically, which is the case because interest rates have gone down drastically, there shouldn't be an issue, assuming that this fiscal expansionary stance is sustained for a few months, maybe for a year, for one more year. But obviously, if it's you have the situation for several years, then yes, there might be a problem. But I think we're not there yet.
So if we take a look then at one of the weakest players, I mean, amongst the weakest players on the continent, is there risk of any country going down the route that Greece has taken?
I don't think so, because at the end of the day, in absolute terms, those deficits are small, and as long as those countries implement the right set of policies, they will probably be bailed out by the IMF and the World Bank. I mean, let's just take the case of Ghana, for example, in 2009. Indeed, the deficit, as I said earlier, was 15% of GDP in late 2008. But the IMF and the World Bank provided the substantial financial support by mid-year. And that's because this country is seen as the good example because of its transparency level. So I think really this risk is quite limited at this stage.
Also, it comes down to the fact that, you know, if government can continually roll over debt by issuing new debt, it cushions them even further. We've got most Sub-Saharan Africa central banks having slashed interest rates, injecting a substantial amount of systemic liquidity into the system over the past 2 years. Let's go through the kind of demand that we're actually seeing now for government treasuries on the continent.
Well, that's really the point. Demand for government paper has remained extremely strong. Actually, it's even stronger than before because of this excess liquidity. in a country like Nigeria, just to give you an example, the 10-year bond yields now 5.76% on average. That's coming from about 11.6% in January 2009. In a country like Kenya, the latest 10-year bond yields 8.6%. That's coming from 11.8% in July 2009. And you see the same trend across the board. I mean, at the short end of the curve, in a country like Zambia, the 91-day T-bill is today at 2%. It used to be at 19% last year. Even in countries with high rates like Ghana, we see a downward path. So it's become relatively easy for governments to finance the deficit